and she has a team of contractors that she works with to renovate properties, because often in real estate investing you need to do some work on these places. And lastly, we've got Jenny, and she runs our management piece of the business. So leasing up of your properties and any ongoing management that's required. Matt's not on here.
I don't
So
do anything.
we don't know what Matt does.
I don't do anything.
Matt runs the whole thing. We're going to put his head at the top in a halo. I do real estate investing. This is some of the stuff I've done. Let's go quickly through what's happening in the market. We talk about this every month, and I'm sure by now you guys are sick of the headlines, because for those of you who are regular here, this is the headline, right? It's the 30% drop in sales, or the 40% drop in sales. But in reality, we're looking at, this is comparison to some of the hottest years that we have, and we are seeing, a trend upwards that's in line with the season. So even though sales are slowing, we'll see prices later, and we know that's very different, telling a very different story. Wow, it's really laggy. Okay, here we go. So new listings. This is something I like to, this is one of my favorite slides. So this tells you really what's happening in terms of new activity happening in the market. So what's coming in terms of new inventory. We're seeing that actually inventory is kind of not at its peak anymore. Like, it's coming down from its the year-over-year high from last year, and it's kind of in line with 2016. So we're not seeing tons of property out there right now. And if you're one of our active investors who's working with Sam and his team, this is kind of the reality. We find a couple of good properties, and to act on it, your time is quite short, and it's mostly inventory driven again. So this is, like I said, this is the big headline we're seeing. New listings, quite a bit of a slowdown. This is the active listing story that we talked about last month as well. So this is the old inventory that's still sitting on the market. So a lot of people have old listings that have been sitting there for a long time. They're not clearing out. That's why we see such a high number here. And average price, compared to the highs of last year, we're now down 12%. And days on market at about 20. And this is much more of a normal figure. This is a ridiculous number, 9 days on market. Economic indicators. So why do we care about this stuff? I always talk about economic indicators. I'm going to stop pushing out information and start asking you guys questions.
Actually, the better question is, who's been to our meetup before?
I think a lot of people.
Okay, so you guys new?
Yeah.
Okay.
Welcome.
Okay. So you've been here too, right?
Yeah.
So the reason I ask is because we explain a lot of the stuff over and over again.
I won't explain as much then.
Okay.
Everybody's a regular.
But for our new friends' benefits.
So we care about economic indicators because we care about investing with fundamentals. We don't care as much about the lagging indicators, which are things like what do things sell for. That's already what's past. We're trying to look at the indicators which are going to tell us what's going to happen in the future. We know all real estate is really supply-demand driven. Based on that, what's driving our demand, which is population. So that's where we start to look at these things. These things are what really push population growth within the city.
So I'm just going to interject quickly. So what you're going to read a lot about is, for example, average sale price, and they go, oh my God, stuff is selling this month for 100 grand more than it sold last month. Oh, that means prices are on the rise, and time to get in, or something like that, right? That's often what we see. But the reality is, if you're looking at average sale price or anything like that as an indicator of what's going to happen in the future, that's like trying to drive looking in the rearview mirror.
Yeah.
Like, that's what it is. You're looking in the rearview mirror and you're trying to drive. And that's not a good way to go. And not that we have a crystal ball, but we look towards these things called economic fundamentals to help understand to at least have an educated hypothesis on where things are going to go. Because we do understand that economic growth, or GDP growth or whatever, leads to job growth. Job growth leads to population growth. Population growth leads to lowered vacancy because people move into a region and they have to rent. Lower vacancy means higher rents. Higher rents eventually means higher prices. And that's about an 18 to 24 month cycle. So that's sort of how we predict, and I don't want to use the word predict, but at least we have an idea of where things are going to head by looking at these fundamentals. So that's why we're looking at them.
And that's why, like, everybody who's been here, we know that what's happening in terms of mortgage qualification changes, in terms of political changes, these are influencers to the market, and that they will make an impact. But at the end of the day, the drivers are these things. If we still have good jobs, we still have population growth, we still have open immigration policies, and people are coming into the city, that's what's going to drive prices at the end of the day. We can make mortgage qualification tougher and tougher, but like in the 80s with super high interest rates, the market still will move. So these are some of our average sales. To actually dive into the deeper data. So we like to show the summaries because this is what's driving a lot of the conversation. But for us as investors, average information and summaries, not particularly useful. It's nice to know what an average detached home is compared to this time last year, but it doesn't really tell us very much. And we get very conflicting information from headlines. We're hearing that the Toronto market's soft. Maybe it's time to grab a good deal. But we'll show different information. So what we do is we actually track area by area, the like-for-like properties. So we use something called the home price index, which is a lot more useful in terms of information for us as investors. So let's say it's a two-bedroom home, two-bedroom detached home, or three-bedroom detached home. This home price index follows that type of property as it gets traded. So it's a much more accurate picture. And the reason we care about that is because, let's say 1 month there's a lot of condo sales, 1 month there's a lot of detached home sales. Well, detached homes cost more than condos. Therefore, your average sale price is going to be higher on the months that detached home sales are selling versus months that the condos are selling, right? So these are the neighborhoods you guys are familiar with that we concentrate on. So CO1, W1, W2. We don't really look at CO2 because it's Yorkville and Annex, and they're just too expensive. So they don't make sense for us as investors. We also look at EO1, EO3, and maybe a bit of EO2. So this is what we're seeing in terms of single family, detached, in the downtown core. The blue line is your overall Toronto, and this is, so the blue line is the overall Toronto, and this is the average home sale price on TREP, correct?
Yeah, so that's all GTA.
So this is all GTA average.
Toronto versus GTA.
So if you look here at the areas that we concentrate in for investment properties, you see a very different picture. So while you see Toronto kind of hitting its peak, April into May, and then dropping and kind of leveling off over the last couple of months. We see very different things happening in places like W1, which never really took a hit and has continued to surge upwards.
So where's W1? Where's W1? Come on. High Park. Ron C. Well, good. You're paying attention. W1, High Park, Ron C. Right? W2 is where? Dovercourt, Wallace Emerson, right? CO1 is sort of your downtown core, Little Italy, Roxton, for example.
And we see all these on the west side. So W01 has taken a big lift, but you'll see the same in W02. That's the peak here. We're very close to that peak again in W2.
The general takeaway from all this, you don't want to read all the small numbers and try to track individual lines. The general takeaway is that in many, many parts of the downtown core, meaning west side of downtown, east side of downtown, we're almost back to peak pricing from last year.
Yeah.
So May of last year, I think we can all probably agree that it was sort of the peak, right? And most people think, like we just had a client, we had a call with a client, she's like, I want a deal. I want a deal right now. I'm like, sorry, you're like 4 to 6 months too late. Like 6 months ago, you could have found something. Probably like October to December last year, you could have found something. There's no deals to be had right now. We're back to the same level of pricing we were in May of last year. Track the lines in downtown. We're effectively back to where we were, and that's a shocker for most people because the headlines aren't saying that. Right?
And we've told everybody that comes to these are the areas to invest in because they meet all our they meet all our investment fundamentals, right? Good transit, close to the downtown core, the right tenant profiles. So, if you listen to us, you find these areas, you're doing pretty well now. So what's bringing this average down? What's causing this turn for Toronto and Greater Toronto areas? It's these guys. So areas north of the city, North York. That's really what's bringing down the average because
they just haven't recovered yet.
That's what.
Oh, that would have been dramatic if you didn't screw it up.
This is too advanced. And so this is what it looks like. I mean, they just haven't recovered. They're kind of flatlined. They hit their peaks, and they're kind of flatlined since about October.
That's about anywhere from 17 to 19% down from their peak pricing. So they haven't recovered. You're seeing a small uptick in a few of these areas, like 1 to 2%, but for all intents and purposes, it's down a 15+%. And whereas
nowhere near the peaks, right?
And then downtown, you're within plus or minus of a very short range of where the peak was last year. There's two different cities we're talking about, two different Torontos we're talking about, effectively.
And these places don't meet our criteria, our investment criteria. They're too far from the transit hubs. And the transit hubs that are there, the commutes into downtown are too far. The property prices are too high given the rents that we're able to command in these areas. So we haven't been advocating these areas as investment areas. And these are condos. Condos have been crazy. And we expect this. And we're tonight is condo night, so we're going to dive into this a lot more. But this is mostly due to affordability pressure at the bottom and mortgage qualification pressure at the top. So what I mean by that is, as all housing prices have risen, the absolute floor of the investments has gone up. You just can't buy a $200,000 property anymore. So if you were looking at $200,000 to $300,000 properties, $400,000, all those people now squish up to the $500,000-$600,000 price range. At the same time, if you were looking at a $700,000-$800,000 property previously, because of mortgage qualification changes, you can't qualify for those mortgages anymore. So now you're pushed down to the $500,000 price range. That's why we're seeing this. Everybody's kind of squished into this band of $500,000 to $800,000 of qualification, and condos are really the only player in that area. What's news? So something we do at Volition is I do. You guys don't care. I like development a lot, so I'm a member of design review panels and like the Don Mills Crosstown panel, and I've joined all these boards. And really, I'm just nosy and I want to know what's happening far out in the future. But there's some really interesting stuff that comes out of this. And one of them is like new projects. And this one in particular is going through zoning approval right now.
So 2 Carlton would be Yonge and Carlton. Young College and Carlton.
Yeah, so this is like exactly in the area. Now this is like, this is not funded yet, this is not approved yet, but this gives us a really far look into what developers are trying to get to. And this is the second submission. The first one, they wanted to put an even taller building in. This one's 73 stories. And the initial submission got rejected because it was like too tall, and the shadow it was casting was massive on the neighborhood. They actually use shadow and sunlight analysis, by the way, on these kind of buildings. But this one in particular, whenever it gets green-lighted, was really interesting to us because it met a lot of the condo fundamentals that we'll talk about today. The location, first of all, is fantastic, but it's got 2-bedroom and 3-bedroom layouts, which you'll see a lot more of now coming in condos because of the shift in demographics, which we will also get into more tonight. But this is an example of something that we may or may not see green-lighted in about 6 months to a year's time. Let's get into the meetup tonight.
Yeah, this is mine.
This is yours.
Oh, okay, here.
Well played.
Yeah, I know, nice. So for those of you who don't know, so Volition Investment Properties, we're a real estate investment firm, and our mandate is really around helping you. It's really around. There's a slide that I used to show that had this guy. He was like looking at a maze, and then it's more impactful if you actually see the actual slide. But he's like looking at a maze. Okay, imagine that this is a maze, right? This is the guy, and this is maze, and he's like, oh my god, how do I get through here? Well, our mandate, what we try to do, is try to pave the path for you, right? So the idea, yeah. See, this is why I need my whiteboard. They wanted to get rid of my whiteboard. I was like, no. Anyway, the reason I talk about this is because our mandate is really to try to help you and try to get you visibility and understanding on how to invest in real estate properly. And also, we want to be that helping hand to help you through the entire process. We're certified real estate investment advisors. I was mentioning to these guys earlier, we're up for a real estate award. It's the Rain Michael Milner Leadership Award. So thank you for those who've helped nominate us. And we're part of Rain. We're Rain's. Do you know who Rain is? Rain is this real estate investment network. They're the largest real estate investment organization in Canada. We're Rain's exclusive Toronto realtor for the entire Rain community. So, we're here. Hopefully we can demonstrate that we have some knowledge and expertise, and we genuinely want to help. And we have clients who, if you want to talk to some of our clients, they're here. And so anyway, I just wanted to give you sort of a baseline. Like, we're not here, there's nothing here that's available to be sold to you. We're not trying to sell anything to you. We want to educate you. And if you choose to work with us, great. But if you don't, you can still take this information. Hopefully it'll help you in whoever you work with, right? So anyway, with that aside, why pre-con and why now? So we were talking about it before, and Martin and I were talking about it. The problem is that, for last 2.5 years, 3 years that we've been running this meetup, we've always been talking about, get into land, buy dirt, buy a house, not these boxes up in the sky because, the values in the land. The reality is, for most people, they can't get into that anymore. A couple of years ago, you could. We had clients who, with, pretty good salaries, be able to buy well beyond what their salaries should have been able to because of the mortgage rules back then. Now, not a reality. They've reined in all of the mortgage qualification. It's harder for investment property to qualify for investment properties. We know this, January 1st stress test, so you have to qualify at 2% higher than the contract rate, than the rate that you actually see on paper. That erodes 22 to 23% of your mortgage qualification. So, hell, if I qualify for $1 million mortgage, all of a sudden I can only qualify for 770 or 780. That's a huge difference.
And sorry, just to add on to that, we're not political or have any political affiliation in any way. But there are policies that are being talked about right now which will actually make this more difficult. So both NDP and Liberal governments are talking about increasing the they choked a bit there, but increasing the difficulty to continue to slow down the market.
So yeah. Okay.
Just know that if they come into power in Ontario, that may become a reality. May become even more difficult.
Another reality is more equity and down payment may be required. So most of us know 20% down is kind of the minimum for an investment property if it's not your principal residence, right? was talking to the Vine guys, talking to David and Chris and Hugo. They're like, 20% down, while that might be the bare minimum, is not a reality, may not be a reality for most people anymore. You might need 25% down or even 30% down because your mortgage qualification, if you want to buy that same property, your mortgage qualification is less, you need a higher down payment. Like that might be, rewind, I can't remember, 10, 15 years ago maybe, 25% down was actually the minimum. And then they changed it to 20%. Like these things are just regulations and rules and that ebb and flow. So even though the rule might be 20%, the reality might be a bit more. So the question is, so more equity might be required. The question is, how the freaking hell do I get more money, more equity? And again, this is why we're talking about this as a strategy that might make sense for you. Rising interest rates. So, of course, when you think rising interest rates, the first thing you think of is, oh my God, my mortgage is going to be higher, it's going to be harder to cash flow. Yes, that is also a reality. My point here is rising interest rates actually make it harder to qualify for a mortgage as well. Because if you're familiar with how you qualify for a mortgage, you need to look at your GDS and TDS ratios, which are your gross debt service and total debt service ratios. I'm not going to get into now, but just know that it's going to be even harder to qualify for mortgages as interest rates go up and because of the stress test introduced on January 1st. Okay?
We're not saying that land is not still where you want to be. At the end of the day, value of real estate is never in the building, it's in the land, right? So you want to get to land eventually. But this is a way to get to land because the reality is jumping in is too difficult right now. And the amount that you're able to grow in equity with a purchase and time working for you is far more than you can save yourself. Right?
Yeah, so Ming stole my headline right there.
There you go. Nice
if you want to
read, for you guys.
if you want to read nothing else on my slides other than like just read the headline, bottom line. Tombstone. So yeah, like Ming said, like it's that right now, what might be the reality and what might be the strategy for, what is the strategy for a lot of our clients now, is this stepping stone approach. So no longer can you just dive in and buy that triplex or sixplex that our clients were able to do before. Now you might need to be building more equity, taking a stepping stone approach. That stepping stone approach is to buy something smaller now and then build that equity, and then use that equity to eventually get into better assets. So pre-construction is a way to do that. The question is, okay, what about resale? Escalating condo sale prices, so we just saw, we have escalating condo sale prices. The problem is rents haven't followed in lockstep. Rents have gone up, yes, but they haven't followed in lockstep, which means often 98% of the time, condos are cash flow negative right now. If I were to buy a condo at 20% down, chances are it's going to be cash flow negative. So the problem is, like, how do you maintain an asset if it's cash flow negative over a long term? I have to keep on paying into this thing, right? It's not a sustainable strategy, and it's a strategy that, okay, if you do one, maybe two, okay, maybe, $50, $100. If I want to buy a lot of these things, I have to get a second job just to maintain my investments. That makes no sense, right? So yeah, pre-construction condos. The idea is lock in at today's prices, future rents are escalating, and better chance of cash flow in the future.
Does anybody know how much rent has increased year over year, last year, this year?
Like 10%.
Close? 17. So not close at all.
17?
17%. This is the secondary market.
On condos specifically or general?
Yeah, so secondary market, which is condos, not primary market, which is like those purpose-built apartment buildings, but things that like we're investing in. Yeah, so it was 17% increase in rents from last year. So it's coming up.
Yeah.
I thought it was 10.
Yeah, I see 10 in the media, so I was like, where'd you get the 17 from?
He just made it up.
Yeah.
Where's your references?
But yeah,
Gallery.
it's really, rents will definitely pull up because of what we're seeing in compression at the bottom end, right?
So we'll just do, these are not pretty slides. Oftentimes I try to jazz them up with photos and other stuff. I just didn't have the time, to be honest. But content's here, and I'm here. So that's all that matters.
Pros.
And the whiteboard's here.
And the whiteboard's here. Okay, so we'll go through pros and cons. It's going to look very dry, so I'll just use these. Don't stare at this too much. Look at me.
Okay.
So basically, like the mortgage, right? You don't have to get a mortgage until the condo registers. So good for people in certain situations. Maybe you don't qualify for a mortgage right now, or qualify for, or bruised credit, or going through a divorce, new to the country. There's all these scenarios in which it might make sense to try to get a mortgage in the future, and not now. Or too many mortgages right now. I have too many mortgages, but I still want to continue to invest. What the hell do I do? So I mentioned we have some very high net worth clients. They earn very astronomical salaries. Think like upper executive levels at corporations. Yes, they have large portfolios, but having trouble getting mortgages. So they have all this cash. What do? Pre-construction is still a way for them to still invest and not have to worry about getting a mortgage. Pre-con here's a good one. It doesn't hit your credit until it closes and you actually have to get a mortgage. Meaning that, so Sam's gonna hate me for saying all this, because the reality is a lot of builders now are actually still requiring you to still get mortgage approval.
Yeah.
So before you didn't need all of this, or you could get a pre-approval letter, which is super easy. Now they actually want to see a mortgage approval from like a big 5 bank. So anyway, so take what I'm saying with a grain of salt, but take the point away, not exactly take the intent away. But anyway, coming back to what I was saying about pre-con, it doesn't hit your credit. So even if you have to go through and get a mortgage approval or whatever, so imagine you have you go to buy a resale condo, let's say. You buy a resale condo, it closes, I get a mortgage, that mortgage now shows up on my credit bureau, right? So even if I wanted to buy something a few months later, they go, oh, okay, I can see they have to pull your credit, they can see that you now have this additional mortgage. Imagine you're buying pre-construction. So pre-construction, you're not actually taking that mortgage out. You had to get that mortgage approval in the beginning in order to still satisfy the builder's requirements. But you're not actually taking out that mortgage, meaning that there's no limit to what you can buy. You're not actually being constrained. Hell, maybe you want to buy a resale and a pre-construction, or you want to buy a couple of pre-construction condos. You're not gonna. They're not gonna see how many you have, so they're not gonna limit you the same way that if I tried to buy a bunch of resale. Does that make sense? I don't know. I thought this was more groundbreaking than.
I'm like, do I need to buy one before I close on my condo?
Yeah, no,
Next
actually,
month.
no, you're actually right. So for example, so Florence is buying a condo, closing next month, and that hasn't hit her bureau yet. So she could go and buy pre-construction now, and it wouldn't affect anything. I don't know. I thought this was.
Supposed to buy a pre-construction condo. Yes, I would.
I need to get before I approval to keep myself.
Okay, forget it. Apparently this is not as revolutionary as I thought it was.
But
Gonna be.
Can anyone know about that, or just they don't really know what we're talking about?
Oh, okay. Do you know what I'm talking about, or did you already know this, or did you not find this interesting?
The point is, if you have the capital, you could go out and buy a bunch of pre-construction condos. You do have to close on them at some point.
Or you could get out of them before.
There are ways, but you're not. It's not like finding 10 mortgages at once. And mortgage qualification is the #1 thing that will stop you from buying an investment property right now. You can make a ton of money, you can have a ton of capital, but it's still very difficult because of mortgage qualification right now.
So, do you understand?
This is a
The
bit
point,
of a
or is this not
bypass
interesting?
around that problem.
All right, I'll move on. I'm beating a dead horse right now.
Sorry.
No mortgage payments to deal with. So, if you were to buy, like I said, no negative cash flow, no mortgage, all that crap. Okay, here's a good one. Headache factor. What is it? Headache
adjusted return. No.
Headache adjusted return. Headache adjusted ROI. You talk to any investor, they will always talk about returns or ROI. Here, we talk about 3 different returns or ROIs. ROI, regular ROI, headache adjusted ROI, and risk adjusted ROI, right? Now, if we're taking on a bunch of risk, like buying in a risky area or whatever, in order to achieve our return, that wasn't as good a return as something that would be lower risk. Same thing for headache. If I could find something that was lower headache versus something that was higher headache, even if they had the same ROI, the return on the headache adjusted ROI is actually way, way better if I have less headache. Does that make sense?
When anybody gets started in investing, the first thing you do is you look at the numbers and you're like, oh, the most return possible. And then you get a couple of these properties and you're like, oh my God, it's not worth it. Because it's such a pain in the ass.
Tenants are a big freaking pain in the ass. Like they're the biggest risk to our business.
And the additional cash flow that you get from these higher risk properties is just, it's not worth it, right? And everybody goes through that experience. So take it from us.
Well, look at what Martin's got, the piece of paper.
Oh yeah. The one that we have a couple copies of.
Yeah. Is there, Sam, did we print off any more?
Yeah.
Did you guys get? Oh, you guys got one? Okay, good.
So that's, we kind of talk about it at a high level in the article.
It's basically the same thing. Like tenant risk is the biggest risk to your business. And so not having to deal with tenants, you've eliminated one major source of risk in your business. Okay? Here's a good one. Delayed deposit structure. So make your capital go further. So imagine that you could put it down in 5% in 30 days, 5% in 90 days, and 5% in 180 days, and then nothing more for 5 years. So contrast that with 20% down on a resale condo, let's say, 20% down, plus the closing costs, land transfer, lawyer fees, and everything that's due immediately. This is actually a way to make your capital much further over a longer period of time. So now, you'll eventually need to come up with that money, but I need to come up with it in 5 years, not now. It's a big difference, right? Things could, in 5 years, I could come up with the difference. Even if I only had this much now, over the 5 years, I'll go, okay, I can save towards another 5% or something like that. So it's a really powerful strategy to leverage your capital to go further. Okay, so anyway, the point is all these great pros. I think I've got another slide of pros. Just like any investment, it's all about trade-offs, right? So we're showing you the pros. We're also going to show you the cons. Actually, we've got more pros. I guess we've stacked it in favor of. Okay, VIP pricing incentives. So what we're showing. Okay, this is essential. So are we saying go buy a pre-construction condo and buy it just from anyone and buy it at whatever? No. Buy it from a platinum VIP broker who has developed relationships with the builders to ensure that we're getting it at ground level pricing. This is a risk mitigation strategy. The reason being, if we can get in at ground level pricing with VIP broker phase 1, not open to the public, only a handful of agents sort of thing, that actually means that we can actually have some built-in equity. We can purchase it at a certain price, and because we know that once it gets opened up to the public, it's actually going to be offered at this price. And other people are buying at this price. This is now the market price. We bought it here, and it's now here. That could be anywhere from $20,000 to $40,000, depending on or more, depending on the builder, depending on the project, and depending on the size of the unit and how expensive it was and all this stuff. We've seen, Sam was saying, anywhere from $20 to $50 per square foot jump once it reaches public. So, yeah, risk mitigation.
There's a saying in real estate, money's made on the buy, and it's applicable to all investments. Pre-con is no different. So do what you can to get the best deal on the buy. You know, Hui, who does tons of renos to flip, will tell you better than anybody else. If you don't buy it at a price that makes sense, you're not going to make any money at the end. So,
For me to say, for me to, in order to invest in freehold house, I've been investing in pre-construction condos before.
Yeah.
So it helped me. Without pre-construction condo investment, I wouldn't be there.
and now Hui has so many houses he can't remember where they are. He had to pull up a map and he was like, I think it's around here somewhere.
Actually, I have more condos than houses. I still have pre-construction condos.
Oh, it's still coming up too? Nice.
Oh, that's good.
Well, to be like Louis.
Yeah, to be like Hui. I thought you want to be like Sam, but I guess you want to be like Hui.
Oh, Sam's still pretty good.
Yeah,
Lots of
you want to
vacation.
be like Sam. So today's pricing, buying at today's prices for a future builds, which is traditionally worth more after it's being built. Lots of reasons why, inflation or growth or whatever you want to call it, but also you're buying, and this is a pro, and also I'll get to it as a con. Actually, I'm gonna wait. It's in my con list. So, yeah, just wait. Market growth and values, market growth and rents. I think we all kind of know that where those trajectories are headed. We just talked about them. It's a way to take advantage of those things now, especially when the writing's on the wall that Toronto is slated to have. It's currently at 6.75 million people, and it's slated to have 9.7 million in 23 years. That's 47% growth in our population. 23 years. And I'm not just making this shit up. This was on the government of Ontario's website. It's insane. Okay, cons. No equity growth. So you don't have a mortgage. You're not paying down a mortgage. No positive cash flow. Well, you're not having positive cash flow because you don't have any rents coming in. You don't have a tenant, right? So you can see that there's like flip sides to everything. Occupancy fees. So occupancy fees are when the building's done, but it has not yet registered as a condo corporation, meaning that you can't. It's at that point that you can take ownership of it. So they finish the building, right? You know, your unit's done, but you don't have access to your balcony sometimes, or the gym's not done, or they're still half-assed the lobby. That's very typical, right? But they're like, oh no, but you can take possession of it. You're like, no, the thing's not done. But you don't have a choice. You have to take possession of it, right? You take possession of it, but you don't own it. You're essentially renting it from the builder until it registers. So when it registers,
period typically?
this could be anywhere from 3 months, 6 months, 12 months. It could be longer. This is actually not due to the builder. This is due to the city. The city has a backlog. So if you're like, oh my God, my builder sucks or the developer sucks, it's actually not the builder's fault. It's the city's fault. So the city has a huge backlog of this, and it can take, like I've seen anywhere from 3 months to 12 months. That's kind of that range is fairly typical.
And how much would it cost? Like, it's not like you pay the same amount you pay for rent. It's like way lower than that, I'm assuming.
It's what you would pay for rent, essentially. During this time, so there's a I was going to show the calculation, but it's a very complex calculation, and I didn't want to show it. Effectively, think of it as what you would pay mortgage for a mortgage, and with that and your condo fees, you're not really cash flowing at all. So think of it as whatever you're going to be able to rent it out at, it's just going to hopefully just break even.
To that point, you can rent out during the pre-op.
Yes, you can rent it. Oh yeah, sorry. You can rent it out during occupancy. Okay. But anyway, during that time, my tenant's paying rent to me, and I'm paying rent to the builder. So I'm not like I'm still not building any equity. I'm not paying down any of the mortgage. Right. Fees. People overlook this. Development charges, educational levies, hydro hookup fees. Work with your broker, your agent, make sure that they and your lawyer work towards capping these charges. You can cap them on your purchase agreement to ensure that they don't exceed a certain amount. But typically they're like $7,000, $5,000, $7,000, maybe 10, sometimes more. People who haven't capped them, we've seen 20 and 25, and these people got burned because they didn't know what the hell they were doing. And they're idiots. Yeah. So. I mean, if you don't know what you're doing, work with someone who does know what they're doing. Right? Okay, this is what I was getting to before. You're only buying a contract. So we'll go back to today's pricing. Buy at today's prices for a future built unit, which is traditionally worth more. Why is it worth more? Because look at 4 and 5, uncertainty. You don't know what you're getting, right? You're buying a piece of paper, you're buying a contract. You're not actually buying the condo. You don't own the condo. You're buying the right to that condo, right?
Is that how you trade on the stock market? Who knows what futures are? It's like a future on a building. That's kind of like what this is like.
So you're buying a contract that's going to allow you to own this later, right? So you're buying a floor plan. So hopefully it looks, the final product kind of looks like the pictures that they've shown you. Hopefully it's the ceiling height that they told you that they're going to give you. So there's all these uncertainties. But for that uncertainty, you get a discounted pricing, right? So again, it's about trade-offs. As a whole, over the long term, we still have seen that the discount that you get on the pricing versus the price 5 years later is worth it, generally speaking. Okay, so you're only buying a piece of paper, not a physical unit. Uncertainty on the property taxes and condo fees. They'll give you an estimate, right? 59 cents a square foot, which might be right for the first couple of years, but we don't know what that's going to look like over the long term. And you're more subject to the market. So in our traditional model of buy and hold real estate, you buy, you're hopefully at least cash flow neutral, maybe cash flow positive. So that's, a little bit of money or return. You're paying down the mortgage over the long term, right? But here, until the building's built, you're not paying down any mortgage, you're not getting any positive cash flow, which means that you're really kind of just banking on the growth, the value growth. So you're a little more subject to the market and market fluctuations, right? And you don't have as much control over that. That's why it's important to try to get discount pricing through VIP platinum brokers, ground level. Like, don't buy phase 2, phase 3, phase 4. Get in with an experienced broker who has access and relationships to get you on the ground level. That's how you mitigate some of these risks.
And we'll talk more about risk mitigation later on. Okay. But we still want to. That's really good. We still want to follow our investment fundamentals, right? So we're still going to buy in core areas with high walk scores, with high transit scores. We're not looking at pre-con projects which are sitting out in Vaughan or in Markham or Richmond Hill because they don't meet those fundamentals that we still care about as investors. Investing fundamentals, there you go. So, the way we like to look at this is what separates a sophisticated investor from an average investor is looking at the risks that you have in the investment and what are your mitigations to those risks, like taking a risk-based approach to investing. So can anybody tell me what the 4 risk areas are when you're investing in Ontario? It's on the sheet.
Yeah,
you have a cheat sheet literally in front of you.
But it's this. Oh, look, it's the same graph. So basically, it's tenant risk, property risk, market risk, and investor risk. So tenant risk, and the reason it's the highest, is the way that our laws are set up here in Ontario. They're very tenant friendly. If this was investing in Alberta, it would probably be a much more balanced picture. But here, as an Ontario investor, we have to be really careful about our tenant and our tenant profile, because once they're in there, it's very difficult to evict somebody. So we care most about making sure we've got the right tenant, because also, if you get the bad tenant, it inhibits your ability to run your business. It inhibits your ability to make sure that you're getting your monthly payment to pay down your mortgage. And any risk to that business over the long term is the biggest risk to your business, right? To that long-term viability. The next property is the physical property itself, and we'll dive into some of this there. Market, we just touched on, and the investor risk is your risk. This is your lack of knowledge, or not having the right team to execute, or whatever it may be. This is the risk that you actually bring to the investment. So we talked about why tenants are our biggest risk. So one of the big advantages of condos is the kind of tenant profiles that we get. Because we're still buying in the key downtown core areas, we're still getting these best tenant profiles. And what is a best tenant profile? So for us, a best tenant profile isn't somebody that's going to be in there forever. A lifer is not the best tenant profile for us. Why do you think that's the case? Why do you think that we, go ahead.
Because we want them to leave after a while so we can raise
Exactly. So because we're rent controlled in Ontario, we can only raise rents on turnover. And if rents are going up 17% year over year, we want to, every year that we're not turning tenants over, we're missing out on almost 70% increase in cash flow. Now, not to say that cash flow is a deal breaker, but it will certainly help you continue the viability, long-term viability of your business if you're able to turn over. So we care about millennials. They're transient, they're well paid, and they're mostly responsible.
Who do you
they're
guys?
entitled.
Who do you guys have? You have who's in your main floor? Who they're moving out?
Oh, the one that they broke up?
Yeah.
The lawyer and the marketing manager?
Yeah.
We'll say lawyer's still paying bills, so.
Lawyer, marketing manager, rocket scientists.
Yeah.
These are the
Well, doctors coming in.
doctors coming in.
Yeah.
Those are the type of profiles that we see in the areas that we invest in.
I'm moving out because I'm not worthy, so. That's actually the reason I'm moving out. The doctor's coming in. Yeah, better tenant profile. Seriously.
Better tenant profile than herself.
But yeah, so like, be afloat. No, those are the kind of tenant profiles we want. You probably never have had late payments or people like they're generally responsible professionals. I mean, most people in this room kind of fall into that profile, right? And they're transient. So you have couples who are living together. For example, if you have a 2-bedroom, those couples break up, and then they're not wanting to live together anymore, and that's a tenant turnover for you. When you're in your 20s, your life is just more volatile than it is when you're old like me and that. What kind of condo layout? So 1 bedrooms, 2 bedrooms, 3 bedrooms. We advocate 2 rooms. So he doesn't say bedrooms very specifically there. So we advocate 2 rooms, which could be bedrooms at a minimum. Why do you think we want this over a 1 bedroom? I know you're all thinking flexibility. You're just not saying it. So flexibility is what we care about. When you have 2 bedrooms, so either like a 1 with a big den that you can convert into a bedroom, or 2 real bedrooms, it gives you flexibility in the people you're renting to. So you're either renting it out to a couple or a single rich person who's going to pay for extra space, or you're renting it out to roommates, which is my favorite profile because they're even more transient, so they're moving all the time. And it seems like it's a pain in the butt to deal with tenant changes, but the reality is when you're dealing with condos, they're very easy to rent out. You put an ad on Kijiji, you'll have a lot of people coming, and then you get your pick and choose of people that you want to rent it to afterwards.
Actually, I don't know if you're going to get to this, but if you just look at the demographic and you look at work styles, right? So, there's a lot of companies who have work from home arrangements. So, one of those rooms could be an office now, or a den could be an office. A lot of side gigs, side hustles now, right? So, having that what we're going to see on an ongoing basis is a shift towards larger units, 1+1s at a minimum, 2 bedrooms, 3 bedrooms. I'll just give you a quick history. So rewind 10 years ago. There was a plethora, a glut of 1 bedrooms, right? And micro suites, bachelors, all that stuff. Because they were trying to cater to this new demographic that was coming in, these millennials, right? And while it's great, so you look 10 years ago, while it's great, it satisfies their needs now and maybe for the next 5, 10 years. The problem is once this demographic leaves. So this is like a tree, a demographic tree. So anyone who works in marketing, you'll probably appreciate this. Okay, so you've got this, it kind of looks like this, right? So there's like male, female. Then at this stage, you're roughly called 60. These guys are, what's the label for these guys? Huh? Yeah, say it louder.
Baby boomers?
Baby boomers. So these are baby boomers. Okay? These guys, who are these guys?
Oh, who are they?
20s, 30s, entitled. You
No, his
know.
daughter's Gen Z or Gen Z.
Gen Z.
Sounds younger,
Gen Z.
so that's why I'm asking age,
Asks
man.
Yeah.
Yeah, Gen Z.
Yeah. So these are millennials, right? So this, in terms of a demographic, so this demographic, this segment, if I don't know if you know your history, but these guys came through their 20s and 30s and changed the face of every industry, like the automotive industry and technology and everything, including real estate. So that's back when we saw white picket fences and living in the burbs and big cars and that stuff, right? Like all the stuff that you kind of think of when you think like what those baby boomers used to like. What do millennials like? They don't like that same crap, right? Cars, like a millennial can't afford a car. They want to live in downtown.
Buy a car.
They don't buy a car. Car shares, right? No, but literally, you need to when you
However you kids get around.
when you start thinking about real estate, you can't be thinking of just like what's there in front of you. You need to be thinking about all of these things. So like, okay, what's important? Is a car, car important? Where do they want to live? Well, we know where they want to live. They want to live in downtown Toronto. Work. They want to live where they work, and they want to play where they live. Right? That's what King West is, right? So Flo moved out of King West, and now she's moving back into King West. So case in point. But the idea here is figure out what millennials want, and then figure out a way to give it to them. So that's what these developers did, like 10 years ago. Right? They looked at the millennials and said, okay, we'll give them what they want. They want these small suites so they can live in these. Okay, great. Problem is, what happens after these guys are no longer 20s to 30s, but these guys are like 30s to 40s, right? Now they're starting to bunk up, right? So, girlfriend, boyfriend, husband, wife, kid. So how does someone like in a situation like that live in a bachelor or maybe even a 1-bedroom, right? So that's why when we look at floor plans and we try to decide 1-bedroom or 2-bedroom or 2+10 or all these other variants, we know because we look to the future, we figure out what these guys are going to want. They can't live this entire cohort. Once this moves up, there's going to be all of these 1-bedroom and micro suites and these bachelors that are going to be like a ghost town because no one's going to live in them. That makes sense?
There's this massive assumption that millennials would eventually move out of these small places and move into the suburbs to raise families and stuff like that. But that's not what we're seeing. What's happened is partially driven by preference, partially driven by affordability. People are staying in condos. Families are being raised in condos. We're turning into like a Manhattan, like it or not. That's what's happening in the city. So that's why we're talking about 2 bedrooms at a minimum, but 3 bedrooms even better, because we'd be playing long term to this kind of demographic. So if you can afford a 3-bedroom condo, that's really what we're advocating right now.
So if you actually look at what the developer, the mix of the suite mix now, before you would see very few 2 bedrooms, 3 bedrooms. You hardly even see any 3 bedrooms, right? Those would be like penthouse type units. But if you look at the demographic, the suite mix now, you're going to see a higher proportion now towards 2 bedroom and up, like a bigger. Anyway, the point is bigger units. Units that families can continue to live in. Units that they can continue to stay in to do a side hustle or work from home arrangement. That kind of flexibility that we were talking about.
Yeah, the initiative, which was started by Jennifer Kismat, who's the former head planner of Toronto, is called Vertical Cities, and the idea is to take neighborhoods and move them vertically for families. So it's not just layouts of places, things like enough room to maneuver strollers, places for dogs. Like this is what's being considered now, built-in schools into the bottom levels of these condominiums, and that's what we're seeing in some of these new plans that are being greenlighted by the city.
So the other thing is that if we talk about this from a rent affordability perspective, let's say these millennials also, like, as rents continue to escalate, they might not be able to live in a 1-bedroom by themselves. So they're going to have to find a roommate. And so instead of one person paying $1,900, 2 people can split $2,200, and that makes a lot more sense from a financial perspective. No matter what way you look at it, no matter which way you slice it, at least 2 rooms, meaning a 1 plus den or something like that, is always going to be a better bet.
And a real den, not a nook in the wall. Called
The foyer.
Yeah, like a foyer. So next on to so we talked about tenants. Now we're going to go into the property itself. So there's 2 big areas of risk here. The first one being builder risk. So what do we mean by builder risk? Anybody know? Yeah, just gonna say, has anybody heard of Urban Corp? So Urban Corp was a semi-large builder at the time, went bankrupt, and people lost money as a result. There is some deposit protection, and there is a process to get your money back, but you have to go through the bankruptcy process and the creditors who get paid first, right? So when we look at builders, we're sticking with large builders, long reputations, well-funded. That's one way of us being able to mitigate builder risk. But that's always going to be a risk, because even sometimes large companies do rebellion. Location of property. So we talked about downtown core, high walk scores, high transit scores, because we can get the best tenants, which are these millennial tenants that we're after. It also supports the best rents. We don't want to be like, luxury condos and right in like the downtown core, because it's going to be too costly and our rents are probably not going to support the cost of the building. We're looking at just slightly outside of the downtown core, like at financial, just slightly outside of that, where we command high rents at slightly cheaper purchase prices. So we may not be cash flowing, we're still going to be cash flow negative perhaps, but it won't be massively cash flow negative. Areas of gentrification. So some of the condo projects that we talk about are in Regent Park. So if you're familiar with Regent Park, it's gone through a massive change. Like 5-6 years ago, it was still pretty ghetto. But condo prices were very cheap there. You could buy something for like high hundreds, low 200s at the time. Maybe it was more than 6 years ago, 8 years ago then. But now, there's nothing in that price range. It's gone up considerably, and the neighborhood's drastically changed. As the community housing is being taken down and rebuilt to be nice, they've rebuilt the community centers there. The whole neighborhood's changed, and that gentrification bubble has been pushing its way along. And so when we talk about land investments, it's the same idea. You don't want to buy in the area that's already gentrified. You want to buy in the areas that are going through gentrification, so at the edge of gentrification. So that way when gentrification pushes its way along, you're there for the ride. What's a bad location? So something you'll never see us advocate, I should say never, but not in the near future, are things that don't meet our high walk scores, high transit scores. So condo projects that are, along Highway 7, for example, up north, that doesn't meet our walk scores or our transit scores. There's not going to be millennials which are looking to buy properties in that area that work downtown, right? Those commutes would be like 45 minutes, an hour long for them. So no subways out there, there's no rapid transit. So we still care about the same tenant profiles, we still care about the same location fundamentals. Lastly, don't buy cheap, buy smart. There's a reason things cost less, especially in real estate. Cost, return, these are all factors of risk, right? So when you're buying something that's an investment and your returns are lower, it generally means that your risk is lower. If you're getting higher returns, there's always a trade-off. It's not like you're finding some deal. It's just that you don't understand what those trade-offs are. So we advocate, because of the pain in the ass of some of the cheaper investments, to always buy smart. Market risk. So this, Matt touched on this earlier. This is, when you're buying pre-construction, you're more exposed to changes in the market, because you're not paying down your mortgage as you have this investment. You're kind of waiting for a 4 to 5 year period for this property to be built. So how do we mitigate market risk? Well, investing in the right area is a really big way of mitigating the market risk. Because if you're in the right areas, as we showed earlier with some of our graphs, the core hasn't been affected as much as the suburbs, and that is something you will always see. You're protected because you have better access to transit, you are closer to jobs that people are going to. So you may be paying a slight premium to be in that area, but when the market does turn, you are better protected as a result. Immigration. So buying in areas that we know immigration is happening. And for those of you who are regulars here, you know that immigration policies right now, we're bringing a lot of people into the country. 300,000 or so coming into Canada every year. And the push is for more and more. So of those 300,000, what percentage of them end up in Toronto? Does anybody know? People who come here regularly should know. No pressure.
I wasn't even listening to the
Sorry,
question.
can you repeat the question?
Yeah. Of those that come, of the 300,000 or so people that immigrate to Canada every year, what percentage of those people end up in Toronto?
A lot.
40%?
It's about as high as 40%. So the stat is 70% of those people end up between Toronto, Vancouver, and Montreal, and about 40 to 50% of those people come to Toronto. So maybe close to that number, probably a little less. But it's still a huge number of people that are coming to the city. You basically have a small city moving into the city every year, right? So making sure that you're buying an area that's constantly having, the center of job growth in Canada, the center of the economy of Canada, and the center of of immigration in Canada is a good way to, mitigate your market risk. And lastly, understanding the kind of environment that we're in right now, with upward, and I talked about this already, but the upward affordability pressure, as well as the downward pressure from mortgage qualification.
So until some of this stuff changes, especially around affordability and mortgage qualification, you're still going to see, you're going to continue to see interest in that segment, 5 to 800,000 segment. And we all know in Toronto that means condo, right? Elsewhere it might mean you can buy a house. In Toronto it just means condo. So until something changes, we're going to see continued interest in condos. What will happen in the freehold market, freehold being like a house, freehold land, we also think that that's going to rebound and do very well. For our purposes and for condos, we are still going to see interest in condos though. Until some policies change, we got to see something change. That's all people are going to be able to afford.
There has been an increase in condo starts. So this year is probably the most condo starts that are being greenlighted, but it's a total of about 50,000 units, which is like nothing compared to the number of people that are moving in year over year. So we're still not even close to the
Like
kind of
stuff that would need to change is like you'd need to see, for example, the opening up of the green belt.
Yeah.
Right? Opening up the green belt, which is what Doug Ford is talking about.
Oh, but then he rescinded.
Yeah,
Okay,
yeah,
okay,
yeah.
whatever. Anyway, so like, I mean, we're talking like a 15 to 20 year plan, even if that were to happen, right? Opening up the green belt. Does everyone know what the green belt is? So Toronto, you got water. Drop picture. That means I need to get rid of my demographic tree.
You even have blue for water.
Blue for water. All right. Fine.
Use green.
Use green.
Chris, you're gonna make me carry that bloody board back and forth every
Yeah.
time.
Okay.
Oh, you have to bring that?
Yeah, shoot.
We got water. Yeah, this is Toronto. This is Mississauga. This is Scarborough, Pickering, Oshawa, Markham, Richmond Hill. I call all of these areas buttfuck nowhere. No, I actually call Hamilton and Windsor and those places buttfuck nowhere. But around here, you have what's called the green belt, beyond which you cannot do development. So all these big development projects, commercial, residential, condos, and a shopping complex, you're not allowed to do it beyond this green belt. And it's up where, like, actually I sold a property that was like right here once, just within the green, just outside the green belt. So I know where it is. It's like 16th and for example, Leslie and 16th. Like that's freaking far north. Anyway, up here, unless they remove that moratorium, where could you go? This is Toronto. You've got Mississauga here, you've got Pickering over here, Markham, Richmond Hill, Vaughan, wherever. There's nowhere to build. So unless you alleviate that pressure, this is effectively, like Toronto is effectively like Manhattan, Hong Kong, like it's like any other world-class city where you have escalating real estate prices because there's nowhere else to build. So if they ever do that, that could alleviate some pressure on land development, which then could open up more houses to be bought, which then would alleviate the pressure on condos, just as an example.
And even if we open up the greenbelt, there's other changes that need to be made. So, do you guys know what an official plan is? So, basically, it's like the master plan for the city. So, between the Ontario governments, Toronto governments, they create something called an official plan, which is like a long 5 to 20-year plan of what they want to see done to the city. The official plans for Toronto, looking for densification. They call it specific neighborhoods where they want to continue to densify, and they call it specific neighborhoods which they want to protect and keep the way they are now. So the official plans are all calling for additional densification in Toronto.
It's actually called the Places to Grow Act. So if you want to look it up, it's literally what all these developers, whenever they dream up this new project and they want to sell it to the city, sell the city officials and the building department and everything, they go, okay, you want densification? Look, you say you want densification. I can give you densification. I can give you 500 units, 500 housing units in a very small area. That's densification. So that's why you're still seeing all these condos being greenlighted, because it actually aligns to Toronto's plan. Toronto wants this.
Lastly is investor risk. So the best thing to do to mitigate your risk is get educated. Listen to us, but other people as well. Make sure you're getting a diverse set of opinions, and build a team that can execute. So not just having an agent's good, but make sure you've got a lawyer that understands construction, right? Make sure you've got a mortgage broker that understands your long-term plans for investing, not just your next property. Impact of negative cash flow. So one of the things that we talk about is, condos, if you bought now, would be negative cash flow. So your worst case scenario is you bought a pre-con and every month you've got to substitute a little bit of it. Now, with pre-con, because it's coming out 4 or 5 years later, there's a chance that rents have come up and this risk is mitigated slightly. But let's do a worst case analysis. Let's say you took possession of it immediately and you're paying today's rental rates. You're getting today's rental rates. How much do you guys think cash flow influences your return on a condo? Is cash flow a small component of your return? Is it a major component of your return? Is it the most important component of the return on your investment? There's no right or wrong answer.
Well, yeah, there is.
But I'm just trying to get
There is a right and a wrong answer.
But we'll talk about it in detail. Does anybody have a feeling one way or the other?
Cash flow is a very, when you start, okay, so Rain talks about cash flow as an example.
All investors talk about it.
Okay, so people who don't know what they're doing at all don't pay no regard to cash flow. And then people who know a little bit talk about cash flow. And then people who know a lot more than that understand where cash flow actually falls in the overall scope of things.
So let's do a quick real-time analysis. I'll go back to my laptop here.
Not gonna wait for the answer.
Yeah,
He's
we're
trying to show you.
Yes.
Depending on the small.
Because of how much too?
A realistic.
$100.
A realistic.
This is a chart, and what this chart does is it plots the value of the property at the top. So this is increasing over time because we're looking at a 5% appreciation. So this is over a 25-year period, 0 years on the left, 25 years on the right. And over a period of time, the value of your property goes from 500-ish thousand up to a number I can't see. It's far away. But whatever that number is up there.
2 million.
2 million. So over 25 years, your condo is going to be worth about $2 million, right? Which sounds crazy, but think about 25 years ago, the price of properties. They're all like under $100,000. So this is at a very conservative average price increase in 5%.
5.4% is actually the Canadian average over the past 32 years. So just to give you an idea. So it's actually not outrageous. It's reality, actually.
So the line at the bottom, the red line, that is our mortgage. So over 25 years, our mortgage gets paid down from whatever value it is today, all the way down to $0. Did you guys understand those two lines then? Appreciation on one side, your mortgage paid down on the other, and the delta, the difference between the top line and the bottom line, that dotted line, that's your equity. So it starts off with your down payment at your 0, but as you move along 25 years, the equity that you have growing in the property increases. So by the time 25 years has passed, you paid off your mortgage, you have $2 million in equity on this condo. Everybody follow? Okay. So I can plug in a number here in real time. And what this is the monthly cash flow. And what it will do is directly subtract or add that number to your equity. So I'm going to put in $1,000 a month cash flow. So this is like an amazing property that you've got. You're able to rent it out for like $1,000 more than market value. Do you think it's going to make a big or a small difference to the equity that you're building over 25 years?
That's a trick question. Is when you use the cash flow, buy another property?
I'm assuming you're taking that cash flow. That's actually a really good point. Yeah. Let's assume that we're putting that cash flow directly back into the property. So I'm just saving it. Just saving that $1,000 a month. So I'm going to put it in right now.
It's good.
So let's share the spreadsheet.
Is that 1,000? There you go. Let's do it again. 0 and then 1,000. Did the line move?
No.
No, it didn't. There's nothing wrong with this math.
It's broken.
10,000.
Okay.
You see it move
Like
a little
a
bit? Okay. 100. 1, 2, 3. 100,000. Okay, now we have
Yeah, but that's not conversion.
So, in the overall grand scheme of things, cash flow makes such little difference to the growth in the property. That's why when we talk about, risk to your investment, we're talking about areas, we're talking about tenant profiles, because the biggest risk I see here as a business operator of investment properties is the ability for me to make my monthly payments, to have my mortgage paid down, right? Or any impact to the appreciation of my property over time. So I really care about where I'm buying my property. I really care about getting the right tenants in there. I don't really care as much about cash flow, except its ability to help me hold that property, right? If I made a lot of money, I could buy a whole bunch of net cash flow negative properties, right? The reality is we can't do that. But this hopefully puts it into perspective for you guys.
He took my chart.
I know you
He took it to the next level.
I know.
I kind of like yours though. I don't know.
Yeah.
Yeah, me too.
Yeah.
Because I made it.
No, because I like it shows the scenarios what happens if prices stay flat or if they
And
go
then
up.
even
Like,
negative
okay.
one too.
He's like, Mike can do that too.
So these numbers are all adjustable.
Okay, we're running out of time.
Yeah.
But yeah, this is like a real-time analysis. So I can sit down with any of you guys and actually walk through it if you're interested. Okay, so that's the impact of cash flow.
Okay, here, we're gonna do a case study. This is kind of probably why you're here. You're gonna go, oh, okay, what the hell do I actually do with all this information now, right? All right, so again, I didn't make this quite as pretty as I normally would have, so just bear with me. This is a condo. It's called Lakeside Park. It is what Martin and I were talking about earlier today. It's located, boom, right there. So where is that exactly? Okay, this is downtown. This is Queens Quay. This is Union Station. This is Parliament. So why is this so significant? What's happening right here? What is this? What is this big outline? Huh? Come on. I know you know what it is.
It's written at the bottom.
Where? Oh. Okay, so what's happening here? Google Smart City, right? And they're actually, so this right here, okay, do you know what Google Smart City is? No? No, really? Who knows what Google Smart City is? Who doesn't know what Google Smart City is?
Can you just explain it?
Okay, so Google Smart City, it's not Google, it's Alphabet. Sorry? No, they haven't. So they're still in the planning phases. So it's not Google, it's Alphabet, who is the parent company, has a subsidiary called Sidewalk Labs. So it's like a sister company to Google. Okay? Sidewalk Labs out of New York City, headed by someone who was on former Mayor Bloomberg, NYC's mayor, that was on his planning committee. So he's a CEO of Sidewalk Labs. Toronto put out a call to action to everyone to say, okay, we want some proposals to help redevelop our waterfront, because we have waterfront, but it is the most abysmal waterfront I've ever seen. Right? Like, all the other cities in the world take pride in their waterfront. Toronto craps all over theirs. I don't know why.
Yeah, you see all the pictures of the waterfront, it's all skewed westwards. There's never a picture of the east side of the waterfront.
Yeah, it's abysmal. Like, every other city, think about every other city, like, has, anyway. They're finally trying to do something about it, and Sidewalk Labs put a proposal in and won the proposal. So Sidewalk Labs is saying they are proposing to actually come and redevelop this area, but not just redevelop this area in terms of like gentrifying it or beautifying it and putting in nice parks and whatever. They want to create a smart city, meaning like they'll have like sensors everywhere. They can have like they want to build buildings that are like malleable and changeable based upon usage. You can change the spaces. They're going to have like roads that will have sensors on the traffic lights, and they'll have sensors on the garbage cans. They'll know how much garbage is being used, energy efficiency. They'll have park benches that can like move around. Like it's like what they're proposing is mind-boggling, right? What they're trying to build is this is going to be the first prototype for what they hope to be able to roll out worldwide, and this is the place that they're going to do it. They're hoping to do it. It was funny. I was watching. Does everyone watch Silicon Valley, the show? Anyway, I was watching a TV show last night, and they made reference to this. I was like, "Holy crap!" Like, anyway, so you gonna watch it? You gonna watch it? Anyway, it's no small deal. It's a big freaking deal. What they're hoping to do is potentially going to be game changing, and you know. So to answer your question, it's not been approved yet. They're still in the planning phase. They've won the proposal. They've committed basically towards a year-long planning phase, and they're throwing $50 million at it and stuff like that. At the end of which, you know, either party, the city or sidewalk laws, could say no go, or go no go. But things are looking very, very good right now, and this again, this is potentially going to be game changing. So,
why do we care about that as an investor?
Why do we care about this as investors? So, this area is going to pull in 50,000 new jobs in this area.
And to be quite honest, I mean, it's really cool that it's Google Smart City, but it could be like a mine or like a nuclear power plant. Really, if it's bringing 50,000 jobs, to be very blunt as an investor, that's really what we care a lot more about, right? It's going to bring good paying jobs, and we want to have condos in the area that can service those workers.
Yeah. So anyway, location. This area is, you know, East's waterfront, East Harbor. Like there's a lot of different names. Quayside. You're going to hear a lot of different names. Just know where the area is. Don't care so much about the name because it goes by a lot of different names. What's happening nearby? We just talked about it. Sample price per square foot. So condos that we see, 1,000 to 1,100, 1,200 a square foot is what we're seeing for pre-construction condos these days. So how much does that end up being? One bedrooms that are 500 to 600 square feet, about 550 to 650. One plus dens are in the 600 to 750 range, being 550 to 750 square feet. Two bedrooms that are 725 to 1,000 square feet will be in the 700 to 900 range. Two plus dens that are 875 to 1,000 square feet are going to be in the 8 to 950 range. Three bedrooms, so we're seeing a resurgence of 3-bedroom units now, and 3 bedrooms that are going to be in the 900 to 1,000 square foot range will be in the 850 to $1 million range. That's kind of rough pricing for this one project. So this one project, we actually last weekend it opened up to VIP brokers, and we had clients who bought four of them on last Saturday. We're really excited about this project due to its proximity and due to the fact that if you calculate this, we're actually closer to the $1,000 a square foot rather than, this number should have been $1,200 actually, sorry. It was actually about $1,000 and just under 1,000, which is one of the cheapest projects in downtown Toronto, which is incredible given its location and what's happening in that area. So this is slide 1. Slide 2, East Harbor. What's that? So, I'm driving. This is DVP. I turn a corner, I'm now on Gardner. Right at the corner of DVP and Gardner. So, you guys familiar with where this is?
It's a really ghetto, ugly, abandoned warehouse.
It's like an industrial warehouse building right now.
Yeah, I think it was what, P&G or something like that?
I can't even remember.
Yeah. But it's been sitting like that for years now.
Yeah. So this area is going to turn into a 50 or 60 hectare?
It's huge.
Hectare. I got my scale wrong. Very large area, which is also going to bring in another 50,000 jobs. So this is going to be the largest commercial development in downtown Toronto, and it's going to rival that of the size of Yorkdale Mall. So it's actually going to be a huge commercial for downtown. And so stuff that's happening in this area is going to be very exciting. So where's Google Smart City? Right about here. And East Harbor. So we're looking at this area and we're finding projects in this area because we think that this area is slated to just pop for these reasons. Does that make sense? So like these are long-term projects, 10, 15, 20 years. There is going to be a waiting period. Don't expect this to happen overnight, but this is exactly what we look for as investors, though. This is why we look for the fundamentals. We're not just buying because it's cheap. We're not just buying because it's whatever. Like someone told us it was good to buy up in Highway 7 or Markham. We're buying for fundamentals because we know where millennials are going to be. We know where jobs are going to be, and this is what is going to eventually drive real estate values. So, do you know where this area is now? You should know. You don't know?
Yes, I think I do.
Dude,
I think
your
everybody-
property is like right there.
I know.
He's got so many houses he lives in now, right?
I know, dude. Your property is like right there.
Yep.
Anyway, if you want to get an idea of where this is, so if you guys are familiar with east of the DVP at all? Okay, imagine you got like Danforth, right? Danforth here. This is Riverdale. This is North Riverdale, South Riverdale. This is like Leslieville. Okay, Leslieville, yeah, you've probably heard of that, right? And that's where this is, right up
The
here.
thing that's also really interesting about the East Harbor project is it's not only going to be a transit hub, which we care a lot about as investors. Like this is going to be like a new Union Station for out east, but it's also going to be a lot of office buildings are slated there. So that's really important to us because we're always looking for that live, work, play type area, and this will definitely be satisfying.
I forgot to mention transit hub. Yeah, transit hub. Big one. There's going to be a big transit hub. For those of you who've been following the downtown relief line, for example, the downtown relief line is looking to be over near Pape/Logan, and then come down, and then through to Queen Station. So that's why this is an important area. Right? So imagine another subway cutting through here. Again, that's going to take a lot of time. It's going to be 20 years at least before we're going to see anything like that. 10, 20 years. But just know that this is going to be an incredibly important junction and a really important transit hub. Okay? So this is what these are just renderings. We always get sold on nice pictures, right? So I have to throw something in there. So yeah,
It's glowing.
Yeah, it's glowing. Okay, case study. So this is something our client bought just this past weekend. So it's a 2-bedroom, 735 square feet. It's a 214 square foot balcony for $760. This was VIP pricing. I just opened up to Platinum VIP brokers. Deposit structure, we had a delayed deposit structure. This was awesome. Check this out. So 5% in 30 days. Okay, doesn't change. 5% in 180 days. 5% in 365 days. So in your first year, you only had to put down 114K only.
I know. So
It's obviously still a lot of money, but imagine that you were trying to buy a $760,000 place with a 20% down payment, plus land transfer, plus closing costs. The number, I don't know what the number is, but it's higher, much higher, right? The point being, and then you don't have to put down the last 5% until 2022. So they said that the place is going to be done in 2022. I never believe that. It's never true. I've never seen a building being built when they said that we were going to be finished when they said they were going to be finished. Building's going to be complete in 2023, 2024 probably, like at least 5 years. Closing costs, closing fees and everything else, about $7,000 in 5 years, 6 years. Land transfer tax will be $23,000 in 5 to 6 years. The point here is money required for the deposits can be over a long period of time. Delayed deposit structure is such a powerful tool, and it's available if you work with VIP brokers who have relationships with builders who can get you these types of incentives. This is incredible value, right? So we were able to get this for our client. Okay, so let's take a look. Current rent for something like this would be about $26.50. Future rent, assuming 4% growth, so not 17%, which obviously.
Yeah, 17% is an anomaly,
Yeah,
guys.
that's an anomaly.
We're not going to see 17% year over year.
But what we do see is rents, go up, $100 a year. That's pretty. That's fairly typical, let's say, if you were able to get your old tenant out and your new tenant in, sort of thing. So 32, let's say around 3,200 is what in like 5 to 6 years, what it would rent for. Expenses, your property taxes, roughly $200. Condo fees for this were 59 cents a square foot. How many square feet was the unit? 735. Yeah, you guys are actually paying attention. I thought I was boring. This is the interesting part. I thought I was boring you guys. Okay, mortgage. So going back a slide, 20% down on this number is 150. Yeah, something, 150 something, which means your mortgage is the remainder, whatever that is. If you base that on a 3% interest rate and that mortgage value will amortize over 30 years, it's roughly $25.50. Cash flow, minimal, right? Break even at best. As Ming said, hopefully the point was taken that cash flow is not a huge contributor to return. Cash flow allows you to hold the property over the long term. So, don't care about this as much. The fact that we can get to around cash flow neutral is pretty good. Future growth, so 5%. So if we went 5% year over year compounded growth from purchase price of $760, that ends up being $970. So 5 years down the road, we would have grown, the property value could have grown 760, 970. It could have grown to roughly 210,000, according to 5% growth.
For a cash flow neutral triplex right now, how much would you say it costs to get into a cash flow neutral triplex?
Cash flow neutral triplex, 1.3.
3 now?
Yeah, you can't find 1.1.
So-
1.3.
I mean, you have 4 years of mortgage pay down maybe working for you on a triplex. You're talking about a $1.3 million asset to get to the same sort of cash flow neutral spot. That's when this stuff starts to make a lot of sense.
And then I think the other asset class that you can contrast this with would be resale condo. So resale condo right now, if you were to buy something, I mean, you were looking King West, prime area, live, work, play, all that good stuff. If you bought a condo for what you were looking at,
517. It was 1,000 a square, basically.
1,000 a square foot, but
Yeah.
it's similar pricing. Condos you were looking at roughly 600,000. How much in rent? 20.
517 is 2,100 in rent.
2,100 in rent. So anyway, you did the math. Cash flow
That would be negative. So
Cash flow
I'm putting
negative.
10% down.
20% down.
10.
Sorry, 10%
Yeah.
down. Oh yeah, it makes
I'm
it
wrong,
even
you
worse.
guys, so-
So
Yeah.
I mean, if you looked at
I think it'd be
condos,
Sorry, you're right. I think it'd be break even if I to 20.
if we looked at, generally speaking, if we looked at assets in the $550,000 to $600,000 range, a normal 1 bedroom with about $2,000, $2,100 in rent, generally speaking, those would be cash flow negative. Okay, total profit. So appreciation growth is 210,000. Mortgage pay down. So we wouldn't have had any mortgage pay down during this time. No cash flow during this time. So your total return, your total profit is 210,000. Let's just say that you close on this thing, and then we turned around and sold it. In fact, the better way to do it is to close on it, hold it for a year, rent it out, and then sell it. We'll get to that. in a second.
Assignments, because I know there's.
We'll talk about that in a second as well. So imagine you sell it, 5% realtor fees. After your value is this, your mortgage is this. You basically, the math works out such that this was total capital invested, 182,000. You put 114,000 down in the first year, another 38,000 towards the end, and then some closing costs, land transfer costs. All of that equals 182,000. If you just turned around and sold it, you would be walking away with 312,000. So in about 5 years, just by putting this down, not having to deal with tenants, not making any dealing with mortgage payments, all the administration, all the headache, according to this model of 5% growth, you've turned 182,000 into 312,000. That's an ROI of 71%, or an annual ROI of roughly 14%. Just by signing some documents and putting your 114. Actually, this calculation is not even that accurate. The reason is because for the majority of the time, you've only put down 114. You put the rest down. You put the rest down just at the end to close, and then if you turn around and sold it.
Yeah.
You know what I mean? Your ROI is actually going to be jacked up. It's actually going to be higher than this, but just for simplicity's sake. The point being is pre-construction offers the stepping stone approach. So now we can take this 312,000 and go buy that $1.3 million triplex. You've turned one of these guys into one of these guys.
How many years was that over?
About 5 years.
It was 5% annual growth rate, so it's pretty conservative.
5% annual growth, right?
So that works out roughly to $5,200 a month. So you would have to save $5,200 a month to be able to do this, essentially, if you're trying to balance out, should I buy now or should I try to save money? The time value is like this is it, $5,200 a month.
So the graphic that I actually wanted to show here was literally going to be like a stepping stone. So I'll draw it since I wasn't able to find a good one. It's like literally, it's like this, right? And the problem is, how do you get to, call this a triplex up here? How do you get to that? You can't get there anymore. Very, very, very few people can get there. Take the stepping stone approach, right? So this step could be your pre-construction condo. Like, the alternative here is this one right here, close and hold and refi. If you were to close and hold and refi, does everyone know what a refinance is? Right? The condo value went up. It's worth $970 at the time you were taking possession, let's say. Your new mortgage, the mortgage we took out was $608, according to the value that you purchased at $760, right? This is 80% loan to value mortgage of $760. What if you were to take out another mortgage, refinance that mortgage to 80% of $970? That's this value here. And then the difference between the new mortgage and the old mortgage is what you can do is you can do an equity takeout, right? So you do an equity takeout, 168, you have enough now to go buy another pre-construction condo if you wanted, or what have you. You could take that and reinvest it in an intelligent way, right? You can see how these are like stepping stones. They help you build equity. And if you're so inclined, I'll go back. You could take 312,000 and you could just sell this and upgrade directly to a triplex, right? So there's so many different options. I didn't map them all out nicely, but the point being, the stepping stone approach helps you build towards building a bigger asset base, or to get into higher quality assets. Does that make sense? I'm trying to demonstrate how this can, well, is there a really better way to put it other than stepping stone? It's a stepping stone approach.
If you ever wonder, for those who are near here, like how people end up with 50 properties or 60 properties, it's not because they're making a ton of money or saving a ton of money. They're just continuing to leverage. So once you build up equity, you take it out, you buy 1 or 2 more properties, you let the equity build up there, you take it out again, and you keep expanding.
Let's do another. Sorry, did I interrupt you?
No, we've got 15 minutes.
Yeah, no. I want to ask Sam, you're in pre-construction. What did you What did you buy it for? How long did you have it for? And how long did you sell it?
Which one? He's got so many.
I know.
He buys them every 6
Just
months.
choose one.
I remember when 2009, first one I bought in King West, Little Bit Village.
Yeah.
It was like a $280,000, 1+1, 2 full bath, for like, yeah, 650 square foot, something like that. Took 4 years to build, and it went up to like $380,000. And the only
So 280 to 380.
280, I think 3.5 years time, something like that.
What's how much growth is that?
And the deposit amount came
What's
up
this
with,
one is?
it requires only 10% at the time.
10%.
10%, yes. And I don't have the money for 10% though, because I was employed, so I don't have like, I could only afford the interest on the line of credit, which I, usually finance the deposit rate. And yeah, rent it out, close it, rent it out for 2 years, and I'm sold for so went out for 1 year, sold for $400,000. And that was like, I guess like 2 years ago. Right now, at this moment, I just checked, just curiosity, how much money I have left on the table. 5 cents. 5 cents.
Hold on. I want to go back to his approach. So, didn't have the money, had a line of credit, or took out a line of credit.
Oh, and it was unsecured line.
Unsecured, no money. He's in your 20s, have no money. Sounds like a lot of us in our 20s. Student or just out of school, God, I've got a freaking student debt. Line of credit is all that's available to me. I took out a line of credit, and I used that line of credit to put down for a pre-construction condo. I only had enough to pay the interest on the line of credit.
It's like $200-300 a month.
$200 or $300 a month.
That's what it costs.
The $200 or $300 a month that you had to pay over the 4 years, but then the equity is grown another
It's around
$100,000.
like $12,000 from the whole month to get this condo, right? And I sold for $400,000.
The return on that is.
And the return.
That's like an infinite return.
Yeah.
Does anyone want to know how to get an infinite return? This is how.
The best if you pay up for someone else's even for the first part.
Yeah, I know. Wow. Those line of credits don't have to be your own. They could be your parents' line of credits, student lines that people aren't using, like med students and stuff like that. That's actually really, if you know med students, that's a really profitable business model if you want to approach them, let me tell you. Yeah, med students, because they don't always use their $250,000 line of credit. They can get it from the bank, and they don't always use it. Because tuition and everything else. Sometimes they have the money already. Anyway, anyone who has a line of credit you can use, and you can even proposition them such that it doesn't. They're not doing you a favor. You can actually pay them higher interest on that. Hey, you know what? Let me borrow your line of credit at prime or 3% or whatever. I'll pay you 4% for that. They're like, okay, I don't have to do anything. I mean, I make money for not doing anything at all. You take that and you invest it in something, and you win, they win. So those are the types of deals that you start thinking about in terms of raising capital, joint ventures, and using other people's money. Right? That was really cool.
Just get it early, right?
It's time. Time, if you remember any of our charts, time is always the biggest proponent to success. Right? Time. You just need to get in early enough. It's always
If you
time.
bought, let's say you bought at the peak last year. If you can hold it for another year, we'll be back past that peak, right? Time erases all mistakes.
Yeah. Okay, let me see. Did I miss anything? Other strategies you could close and hold. So close and hold, you have minimal cash flows. Like I think in this case it was like $25, but you have mortgage pay down. So the mortgage payment was $2,500. Roughly speaking, about half of all mortgage payments are principal, half is interest. So, you're building equity, $1,200 a month equity. So you could continue to hold and then, still ride the appreciation wave. You could refi, like what we just said. You could refi, go buy another one. Hell, now you got two of these things. Assignment. So Florence was just talking about it. So assignment means, so like I said, when you're buying pre-construction, you're not actually buying a unit, you're buying a contract. And so because it's a contract, you can do things to this contract. You can assign this contract to someone else. That's what an assignment is. So let's say that it's approaching being built. The value is 970 because other things have sold around 970. So you go to your realtor, hey, I want to sell this, and they're like, okay, well, I'll help you with an assignment. I'll help find you a buyer for your contract. So they'll buy your contract from you, and then with the beauty of that, no closing costs, no land transfer costs. So it's all sometimes. So if you can build in an assignment into your purchase agreement, make sure your agent does that. So usually there's an assignment fee of like $5,000, something like that. But what it allows you to do is assign it to someone else, and then you can walk away with your profits.
What are some of the assignment cons?
Assignment cons. So assignments can be tricky. We just did one for Fazel, so you guys know Fazel. So we literally just did one for Fazel. It can be tricky in terms of your agents have to know how to structure these contracts properly. And your assignment contracts are actually quite challenging because you put your deposits down. So here's an example. You put your deposits down. Let's say, I don't know, you put $150,000 of your deposits down, right? And then let's say that you bought this place for $500 and you're going to sell it to someone for $650, right? So you want your $150,000 of profit, right? You've put $150,000 down, right? The buyer comes in and goes, okay, well, I'll take your position, so I'll pay you back your $150,000, right? But where's this other $150,000 going to come from? Like, how the buyer needs another $150,000 to take you out of your position? Like, they can take your contract, but how are they going to take out the rest of your position, right? Do you see the challenge here? Normally, they'll come in here and go, okay, I'm going to get a mortgage, 80%. Okay, then I only need to come up with 20%, right? It's simple. But they can't get a mortgage on this yet. It's not, the condo hasn't closed yet. No one owns the condo. The builder still owns the condo. Can't get a mortgage on it. What do you do, right? So it can be a challenging thing to work through. Just make sure that if you're doing an assignment, you have the right people on your team, because they can be very, very convoluted, and you can get some very upset people if you're not structuring it properly.
Yeah, I just wanted to touch on some of those risks, because I think people think, oh, assignment, it's like selling. It's not like selling at all. It's not a piece of land you have. It's not like on MLS because you don't own it. It's more like trading a contract.
The other thing is that typically the value of a place goes up after it closes because someone else has already paid all the closing costs, right? And because now after it closes, you have a physical unit to go and look at and inspect, so people will pay more for that. Less risk, right? So yeah, it's not perfect. Like assignments, again, it's all about trade-offs. Maybe you're willing to take 940 or 920 on assignment versus closing and selling for 970, kind of thing, right? Oh, yeah. Oops.
Imagine a good floor plan.
Imagine a good floor.
So one of the things that I think
Oh boy.
one of the things that's an advantage for us.
Hey Sam,
is,
look.
Can you draw one?
One of the things that's an advantage for us is because we have a full team, which includes a designer who does floor plans, lives and breathes that stuff. Sometimes you can look at a floor plan and it's difficult to understand if it's land is good, is it makes sense for an investment. So having a designer on our team really helps. If you don't have a designer, make friends with one or find one to help evaluate those floor plans. They're not all created equal.
Yeah. While we're on this topic, it's it's things like views, floor number, like how high up. So these are all the things that are going to affect. So for example, again, nothing's perfect. Even I'm going to go back to this guy right here. This condo we helped our client with was right here. This is Queens Quay. This is Lakeshore. What's just north of Lakeshore? Big highway called the Gardner,
Yeah.
right? So this, like, full disclosure, this is not perfect. Nothing is, right? So the unit that we got, you know, the two bedroom layout is, where the freaking hell is it? Okay, right here. So you can see that it's a northern facing unit. It's a northern facing unit, and just, okay, so basically the property line probably ends about here, okay? Then Lakeshore is probably here, and Gardner is probably about here. So you're facing the Gardner. Not perfect, but the price point made a lot of sense. The rents, or future rents, made a lot of sense. The floor plan made a lot of sense. What we managed to get for this client, what floor is this? 15th? 15th floor. The Gardner, we looked at it, we analyzed it. The Gardner goes up about 3 floors, 3 levels. 15 floors, you clear that. It's no longer, you've mitigated that risk of that being a bad view, right? You've mitigated noise risk and all that stuff. These are the things that you need to think about. You need to think about, you know, is there anything going to be, this is a northern facing unit, is there anything going to be built to the north of me that's going to block my view? Same thing, you know, if it was south or anything. In a multi-development, a multi-unit, multiple buildings being built in a development, you know, what are the other buildings going up in it? Are those going to obstruct my views, right? Are there parks that are always or never going to be built on, for example? You know, those are the types of things you need to be starting to think about. And then, okay, so let's talk about floor plan. Just really, really quickly, some very, very quick things you need to look at. Wasted space with hallways. Hallways are a big wasted space. So you look at square footage and go, oh, it's great square footage. Yeah, half of it's hallways. So hallways, you want to look for, you know, if you can get split bedroom layouts, you know, bedroom over here, that's even better. If you can get dens that are almost fully enclosed, just by putting up a door or a sliding glass door, you can turn that into a bedroom. That's really good for a 1+1 type of layout. Bedroom sizes. Sometimes you see like super small bedroom sizes. Roughly speaking, 9 by 9 is a standard bedroom size, and you're not going to want to go too much smaller than that if you can help it. Anything else?
Just to touch on that, so you pay a premium for high floors, but you don't necessarily get a rent premium for a high floor. Lower floors are cheaper, but you know there's a sweet spot that you want to buy.
You don't want to be too low because that's going to affect resale.
But don't be too high because you're not going to get that money back.
And this is all the stuff that your broker, your agent should be able to help you advise on. But like, don't just approach this on your own because there's too many factors that are going to affect your investment. Okay, well we're being kicked out of here. Was there anything else? These were just FAQs. Basically, like, if you have any questions, just ask us. We'll be here. I think we're going to chill out for the next hour. Yeah, so we can hang out. So I think that's all we got. Yeah? Is that useful?
Dang, you guys heard all like stuff you're selling with the price list. Now I'm like,
Oh yeah. No, like
that's a good job.
we've always mandated that this was never going to be about selling, right? This was going to be about education. If you want to talk to us, like we just helped our clients with this particular project last weekend, and I know that there are some available. If you want to talk to us about it, I think Sam can give you some details. There are other ones also coming down the pipe. This one happened to be interesting because it was around the $1,000 square foot range. The other one that's coming down the pipe, Sugar Wharf, is how much?
At least $1,100.
$1,100 a square foot. So you're going to take these prices and put another 10% premium on them for the next project that we're seeing in a couple weeks, a couple months. So, yeah. Cool. Thanks for listening to us, guys. Yay!
That's what you do with your son.
I know. I'm doing this with my 13-year-old. I'm like, yay! Cool. So.